All right, Darren Rhodes here with Eric Halliday. And
Hi.
We're going to wait for a few minutes, a couple more minutes anyway, while a few more people join the class. And Eric and I were just kind of chatting about some of the funner, is that a word?
No.
Some of the more fun experiences we've had in helping people find, well, we don't help them find homes, but buy homes, I guess, get the money.
Yeah.
So, well, why don't you tell that story that you were telling me
Yeah. There's.
while we wait here?
Yeah.
Can't even
There were
remember
so
the
many.
story.
There's so many stories.
We like to tell a lot of stories. Well, we had that borrower that was under contract to buy a house and was working with their credit union, which is totally cool. But
Wow.
yep. And what happened? You remember that story?
Yes, I remember that one.
There's a billion
Yes.
stories.
Yes.
But,
Yeah. So we had a borrower come to. Well, we had a real estate agent we worked with call us like in desperation mode, and she was really upset because she had a buyer that was a first-time buyer that was really excited about buying a home and was under contract and was like, probably 10 or 12 days away from having to close per the contract.
yep.
And her lender called her and said, actually, we've refreshed your credit and your credit score dropped by a point, and so now it is just under the lowest threshold of credit score allowability, or it's too low of a credit score to we can't approve you, so we're gonna have to decline the loan.
Yeah, based on what the credit union's requirements were, right?
Yeah, based on the credit union's requirements. So that was a really concerned buyer. So they called us. We told the agent, hey, look, just have her call us. Let's see what we can do, because the credit score was still within our criteria that we could approve the loan, and we were able to kind of make lemonade out of lemons, I guess you could say.
Yeah.
We got it closed, and they were really relieved. But you get stories like that sometimes. People, and maybe they did something to affect their credit over the first 20 days or 30 days of the contract. I don't know. But something changed and their credit score dropped, and they weren't able to buy the home anymore.
Yeah. And Eric's actually underplaying this a little bit. Eric's really talented at finding solutions for people on the finance side, and they came to the right person, man.
Well, that's true.
So anyway. All right, well, we're going to go ahead and get started. Hopefully everybody's on that's going to be on today, and thanks for joining us on our class. I'm Darren Rhodes, and branch manager of Leader One Financial here in American Fork, and my business partner,
Eric Halliday.
my good friend. We've been good friends for a long, long time, and fortunate to be business partners for a long, long time. And Eric runs our loans in the branch, and we frequently do these first-time homebuyer classes, and we had the idea, you know what? We could probably reach a lot more people if we do it online in the form of a webinar, and so we're just happy to have you here. And if you have any feedback or questions, don't be afraid to shoot them out to us, and we'd be happy to answer them. So as we get started, here's the legal stuff, and this is the fun stuff to read, but we want to make sure that we get our bases covered in terms of regulation. So go ahead and read that. And while you're reading that, I'll just tell you a little bit about myself, and Eric will tell you a little bit about himself, so at least you know who you're talking to, but we won't bore you with that for very long. So Eric and I both have 6 kids each. We're both married to somebody different, right?
Yes.
Yes. So both have big families and have good times with our families. Like we were talking about earlier, Eric's been in the business since 1999, and he brought me into the business in 2001, end of 2001, in that range. And man, we've just been doing mortgages and getting loans and helping first-time home buyers ever since.
Yeah.
Yeah.
It's been a good time.
Yeah, it's been a great time. So let's just jump right into it. Here's our class layout for today. We want to cover three main general topics: the home buying process. We get a lot of questions about the home buying process. How to get approved for a mortgage. We have lots of questions about that and some details inside of that, like credit, down payment, income, things like that. And then before we leave tonight, we want to make sure that you get a map of the very best plan for you. So how to map out your home buying plan. Okay, so let's move right on. So
Yeah, maybe I'll say a word about that. What we find is a lot of people, no one thinks about a loan or a home until it's time.
Right.
It's just not one of those things you kind of read up on. It's not really good reading at night. So they tend to be a little underprepared, maybe sometimes even a lot underprepared. They don't know the financial, what they need to have financially or credit or any of those things. They're just unprepared.
Right.
With a little information here, you'll be ready to roll.
Yeah, because you know what? Nobody teaches this stuff in school, really.
Right.
I mean, I even had a finance class in college, and maybe I slept through it, but I don't really remember any of the details of anything that we'll talk about today. So, all right. So step one. Why don't you start with step one? If you're starting out brand new, thinking about buying a home, it's the very first thing you should do.
Yeah. So the very first thing you want to do is really think about where you want to be. And kind of along with that, how long you think you're going to be there. No one has a crystal ball. No one's
Right.
going to be able to say, okay, I'm going to be here for X number of years. But the time you spend in your home is really helpful it helps you decide what kind of mortgage you want to get, what kind of home loan you want to get, and actually what type of home you want to get.
Yeah, for sure.
So
what's your game plan? For example, first-time homebuyers oftentimes are just getting out of college, and they, or still have a significant other that might still be in college, and they want to, they know that in 3 years they're going to be going to graduate school somewhere, and that can affect your decision. Or just graduated and landed a great job locally, so that could change your plans too. So your game plan of where you want to be and how long is super important.
Yeah.
And we kind of define short term as 5 years or less.
Yeah.
And once you get above 5 years, then statistically, things change in the marketplace. And so above 5 years, we classify that more long term.
Yeah.
There's no hard set rule, but that's what we look at. Also, your lease. Where are you at right now in your rent? Do you have to be out next month? And if so, or are you going to be out in 6 months? How much time do you have to game plan? What are you going to do when your lease is up? Your lifestyle preferences. That's another one. Do you like living in a condo? If you can't stand it, those types of things, then you have to weigh those things in.
Yeah.
So.
Yeah, we just did a loan for a lady that bought a condo in the downtown metropolitan area where we're at. And she, really nice condo. She spent a lot of money on the condo itself. People would compare what she spent on the condo to, a lot of people would like a home for that price out in the suburbs. But her lifestyle was everything that she did was downtown.
Yep.
So it was perfect for her.
Yeah.
So it really does matter.
So you don't really need to know details of loan programs or things like that to get an idea of where you want to be in terms of your game plan.
Right.
You can just say, hey, I like this type of thing, or I have so many kids, or whatever. I will tell you something funny though on being realistic. You want to be realistic. It just reminds me a few years ago, my wife and I we bought a lot and we were going to build a house on it. And as any, of course, good wife would do, she would jump on Pinterest and look at all these ideas of home design and decorating and planning and all this stuff. And she would show me pictures and she'd say, oh, I just love this layout. I love this. And I always thought to myself, well, I didn't just think I'd say it too. I'd say, well, of course you love that. That looks like a $3 million house. So who wouldn't love that? So be realistic. You definitely want to dream, but be realistic for sure.
Yeah.
So, okay. So after you kind of set up your plan, man, you got to figure out a way to pay for it, right?
Yeah, it's true. Unfortunately.
Yep. So that's always the question that we get is when is it too early, or is it ever too early to start the pre-approval process or the application process for a mortgage?
And I'd say no, absolutely. In fact, if you even going back to the previous slide, if you, while you're doing that plan, and you mentioned being realistic at the end of that, the only way to really know if you're being realistic is to, number one, decide what your budget is, what you're comfortable paying.
Yep.
And then number two, is what you're comfortable paying realistic to an underwriter? Because if it's not, then you may not be able to get the loan you want anyway.
Right. So when he says underwriter, he means the bank. Is it realistic to what the bank will be willing to lend?
Yeah.
Yeah. So you got to match those two up. Mm-hmm. Yeah, that's exactly right. And in fact, oftentimes when we're talking with clients and screening them, we'll say, okay, what do you want your payment to be?
Right.
Because oftentimes that's different than what they can qualify for. And the good news is oftentimes that payment is less than what they can qualify for.
Yeah, that's true.
A lot. What do you want your payment to be? And then we'll always follow up with the question, okay, what's the ceiling? Where's the absolute maximum you can go? Not that you ever want to necessarily hit that, but it's just a good idea to know what your range is.
Yeah. Yeah, that's true.
So having those numbers in mind is helpful. And another rule of thumb, and it can vary too, is your house payment should be about a quarter to a third of your gross monthly income.
Yeah.
In that range, right?
Yep.
Yeah. So if you're kind of budgeted around that, then you'll be pretty close. So other options, to think about: how are you going to pay for this? Do you have a down payment? And we'll talk about where that can come from in a little bit. Do you have family members that help? Because oftentimes, mom or dad or grandma and grandpa will say, hey, when it's time for you to buy a house, I can help you, either co-sign or help with the down payment, things like that. But I think the biggest takeaway from this little segment is that, and we'll hit this again and again and again, is that it's just never, ever too early. So if you're going to buy a home next year, then, man, start going through the pre-approval process now, because we found that sometimes people have employment situations where, man, it takes a year to resolve. Not everybody, but you want to make sure that you have a game plan. You don't want to. It's different from a car. A car, you go find that car and you're excited about it. And you go into the finance guy and they do the loan and you drive away. Here, the money comes first.
Absolutely.
You want the money to come first.
And there could be surprises on your credit. We've had people come in and they have a $10,000 medical collection, or even some other kind of collection, or a judgment, or it could be anything, but they have something they didn't know about, or that they knew about and just didn't know if it would affect them.
Yeah.
Just didn't think it was that big of a deal.
Mm-hmm.
So yeah, good to know that up front.
Yeah, so you get so it's never too early. Number one, never too early to start the application, especially when it's free, and we'll show you how to do that a little bit later. So your last thing is, once you start getting pre-approved, you want to get your action items. You'll get a list of things to do and to gather for the pre-approval. Okay?
Perfect.
Okay, so now that you've got the pre-approval in place, the fun part really begins. You got to start looking for that house.
Yep.
And we know that you've been cheating and looking at houses before.
Everyone does.
Yeah, it's totally fine.
Yeah.
But now it's going to get real. So, man, how do you find the right house? We get asked that question all the time.
Yeah, if it were me, that's when I just call my realtor.
Yep.
First thing. Because they have access to so much more information. They have the multiple listing service.
Yep.
I believe it's called.
Yep.
That's
the MLS.
The MLS. That's their online resource that all the homes are on. And they have, you get a good one, and we work with a lot of good ones, but you get a good one and they have a lot of experience.
Right. Yeah, absolutely. And a lot of people are nervous to talk to a realtor at the very beginning, because they think that it's probably going to cost some money out of pocket just to talk or get a consultation. And from what we found, in most cases, when you hire a realtor to be your agent on the buyer side, that typically speaking, the sellers, when you find that house, the sellers will pay the commission for both.
I'm hearing a lot of disclaimers in.
Yeah, that's right.
Maybe it's because we're not agents.
Yeah, we are. Yeah, that's a good point. We're not real estate agents, and so we can't offer legal advice as far as that goes. We can just tell you what we've seen. But in almost every case that we've ever seen, that we've ever seen, the buyer pays nothing to the agent. It always comes from the proceeds of the sale of the home.
Right. So the seller has a lot of times we'll have a real estate agent list the home for sale.
Mm-hmm.
And that's how it gets put on their agents, their MLS. And then all the other agents can see that home. And then the buyer's agent or your agent can find that home and take you, and then set up a time and do everything from there. But you're not writing that agent a $15,000 check day one saying, hey, please find me a home.
Or even at the end.
Or even at the end. It comes through the proceeds of the sale of the home from the seller.
Yep, that's right.
Generally speaking.
And in fact, depending on how the contract is written up in Utah, from what we understand, a real estate agent can actually list a home and can represent you as well as a buyer, can represent both parties. Now, not every state allows that, but Utah does allow that. So if you were to just say, well, I don't need an agent because there's an agent already listing this property, well, what's going to happen is that whole amount of commission that the seller has agreed to pay the real estate agents will go just to the listing agent. But if you have your own agent, they'll split it.
Right.
So it really makes sense, especially from a first-time homebuyer standpoint. In our opinion, it really, really makes sense to get a really good real estate agent on your side. You want to go through your contract, make sure you go through the agreements with them and that you're good to go. But in most cases that we've seen, there's really no cost or any to the buyers.
Even if you're building a house, going to a builder, it's nice to. A lot of people will say it's kind of like going into the courtroom with your own lawyer.
Right.
You wouldn't go into the courtroom without a lawyer. Most people. You want someone who's kind of been down that road before and who knows how to navigate around the little traps.
Yep.
So it's nice to have your own person that's representing you.
Yep.
Yeah.
Yeah, that's exactly right. So, and again, we're not agents.
Right.
And so you want to talk to an agent. We can refer really good agents and just go through the paperwork. The really good agents will be right up front with you about everything and are willing to work with you in any case, from what we found.
Right on.
So Eric, how long does it take to find the right house?
About 24 hours.
Well, that's really fast.
I've seen it happen. No, it really. I don't think you need to put too much pressure on yourself on this part of it. You want to find the right house,
Right.
more than anything else, and so it takes as long as it takes to find the right house.
Yep. And in this market, it could take longer. We've seen people find a house in as quick as a week, and we've seen it take months. So you just want to plan accordingly.
Yeah, and some people put really strange. I shouldn't say strange, but kind of strange, sort of parameters on themselves or constraints on themselves. I've heard people say, well, that right house is not going to come along until I've saved up 30% of the home in a down payment.
Oh yeah.
Or they'll put, or I have to have everything on my checklist. I think you do have to be a little flexible.
Yeah.
Otherwise, maybe the rates will go up on you, and all of a sudden, boom, saving up all that money didn't help you.
Right.
Or that things can change. So I think if you're kind of feeling that urge to go get the house, go get pre-qualified, get ready to go, and then go do it.
Yeah, and it really is all about priorities. We'll talk about making your priority plan here in just a little bit, but the one thing is that we found you want to find the right house for you. So whatever that is, I mean, if you want to save up 50% or 30 or whatever, or there are certain things that are just super super important to you, man, that's great. That's totally fine. So, but just keep your eyes open, and there's lots of options out there for a lot of different things.
Good point.
Yeah. Okay, so let's just briefly go through the process. Once you've found that house, we'll just take a couple of minutes and walk you through what everything is. So once you've found that house, the real estate agent will help you negotiate the offer, get your offer tied down. They'll use what's called a real estate purchase contract that the state of Utah provides, and they'll help you fill it out. And then there's a few important dates on that contract. Right. So do you want to cover those just real briefly?
Yeah, and especially the ones that we affect the mortgage side or the loan, the home loan side. You have probably the most important one is what's called a settlement deadline, and that settlement deadline is when you have settlement. As far as Utah is concerned, settlement means signing. So you need to be providing the down payment money if you're doing a down payment. So let's say you get under contract April 1st and your settlement deadline's April 30th. Well, you have to make sure you have everything ready to go so that you can sign on the dotted line to buy that home by or before April 30th and your money in place as well.
Yep.
So that's probably the most important one, just because you're under contract until that date and the seller is required to sell you the home during that time period. Another important one is you have what's called, in Utah contract, it's what's called the appraisal and financing deadline. That one tends to come, somewhere in the middle between the start and the settlement deadline. And that one you need to make sure that the lender has ordered and has received the appraisal on the property, which sort of evaluates the home.
Yeah, so let's just cover that really fast. Yeah. So as part of the mortgage package, you have to be approved as a person.
Yeah.
But the home, which is the collateral, also has to be approved. And so they get an independent appraiser, which we take care of on the lender side. We order that and take care of it for you. But that person's going to go out and evaluate the value of the home and make sure that the home is worth what the asking price is. And
right.
that really protects you as a buyer, because if it's too high or whatever, then you want to make sure that you're not overpaying for a house.
Right.
Yeah.
Right. And so if either of those, if the appraisal comes in such a way that it creates a problem with getting financing, or if financing, getting a loan, becomes a real issue by that date, you want to be able to know by that date, that appraisal financing deadline, so that you can decide whether or not you want to cancel the contract. There's some protection in there for you, and we can kind of go into that a little bit more. But I'd say those are probably the two most important deadlines that we see.
Yep, and then there's more, but again, a realtor is going to help you through those contract dates. But just be aware that there's timelines.
Yeah.
Like once you get that offer accepted, there's timelines to perform, and you want to be aware of that. And it just doesn't magically happen. You've got to pull your weight along the way. So
right.
Let's talk about really quick what earnest money is and cash to close.
Yeah, and again, the disclaimer, we're not realtors, so we're just kind of telling from our lending perspective what we see. Earnest money, I'm sure there's a legal, technical that your realtor can kind of describe, tell you all the terms and conditions of earnest money. But what it generally is, when you go and put an offer in to buy a home, you give the sellers an offer with a price and everything, and then to make that offer look better, basically to make so they'll take it seriously, you're gonna write them a check, and it may not go directly to the seller. That check may go to
the realtor's usual
realtor, or maybe the realtor will have a title company they hold it with, but you're gonna put money into the deal basically at that point.
It's like a deposit.
Yeah, it's a great way to describe it.
Yeah, like sometimes when you buy a vehicle, you'll give the person that you want to buy the vehicle from $100 to say, I'm serious, or $500, I'm serious. I'll come back with the rest of the money as soon as I've lined up the financing.
Yeah, don't sell it to someone else.
Yeah,
basically.
Just it holds it. So, and the earnest money amounts can vary. I mean, they can be. You can do zero.
Yeah, we've seen that,
and we've seen as high as 10,000. Typically, I don't know what typical would be.
Well, right now it's been higher because people are really trying to sweeten their offers to make them look good. But couple thousand, is a really common amount.
And the cool thing is that earnest money actually gets credited towards your down payment.
Right.
Yeah.
Yeah.
So you don't have to. It's not just money that's gone.
Right. Yep.
So speaking of that, cash to close. How does that work?
Cash to close. This is a good one to kind of go over, because there's two parts to the cash to close. So everyone knows there's going to be some money to buy a home. You're not going to be able to buy a home with, generally speaking, with no money out of your pocket.
Yeah.
There are some costs.
Yeah, and it can happen.
It absolutely can happen.
But you don't want to plan on it.
Right. There's certain loans that are no down payment, and if you set it up just right, you can get into that with no money, literally no money out of your pocket. But there are a few costs along the way. So to kind of make it easy, at closing, you have closing costs and you have principal down payment. The principal down payment is the amount of money. So, for example, you've heard of conventional loans. On a conventional loan, that's just kind of like the standard mortgage loan. A lot of times you'll see 5% down payment. That's a common one that a lot of people do. So 5% down payment means 5% of the purchase price. If your purchase price is $200,000, then $10,000 is your principal down payment. And then separate from that, you may have some closing costs, like to pay the appraiser and the title company and the lender and everybody involved in the transaction.
Taxes,
prepaid taxes and insurance. Yeah. And that can be a few $1,000s. You add all that up. And so the cool thing about that portion, the down payment is yours. The closing costs can at times be paid by the seller. Sometimes the lender can pick up the tab on that.
Can help you out.
Again, but you also there are times where you pay for that out of your pocket. So
if that's what you choose, yeah.
If that's what you choose. So that's the cash to close.
Yeah, perfect. So you just want to be aware that there's money to close, and there's options for it. I mean, there's definitely options for it, but again, be aware that we've got to figure out ways to cover it somehow, and we can totally help you with that.
Yeah.
I mean, that's our job. Is we take a look at what you're bringing to the table. You're bringing X amount of dollars, $10,000. Well, we'll look at that money and say, okay, if you put this much towards down payment and you put this much towards cost, and you get a better interest rate, or there's just different combinations that you can come up with that we'll help you with that will be best suited for you. So
right on.
One thing that comes up sometimes too are inspections, like a home inspection and home warranties, and these are outside of the financing package.
Right.
So they could be a cash to close issue, or if you're buying a condo or a place that has an HOA or a PUD on it, there could be some additional costs on your at closing as well. So you just want to be aware of those going into it. And again, we can help you with that. A realtor will help you with that. But you can find those things out before you actually get to the closing table, so you're not surprised. So just plan.
Again, it's good to that pre-approval process, because those are the things you'll learn. You'll kind of go through the different programs, and you'll kind of learn what the cash to close needs are potentially for you.
Yeah.
Early on.
Right. Yep. So. Super, super helpful.
Yeah.
And then if you're early enough and you need a little bit more, or it's to your advantage to save up a little more, it gives you time to do it.
Exactly.
Yeah. So again, never too early.
Never too early
to get pre-approved.
Right.
Unless you're 5 years old.
I'd still do it. So.
Well, okay. So let's just take a few steps to go through the process from an accepted offer to closing. So again, you found the house, you've got an accepted offer. Let's just walk through really, really briefly, so you're not bored to tears, what that process looks like.
Yeah. So you're.
I'm already bored.
Well, you take over. Now I'm bored. So here's what the phrase we always use: rush on the front end, coast on the back.
Yep.
Right?
Yes.
And then you will save yourself a lot of stress. And a lot of places don't do that. So what we've worked really hard to kind of get our systems down, because it's so important to us that our buyers are not freaking out 3 days before closing because it's not ready to go. So we do everything we can to, right when we get the contract, what will happen is your realtor will give us the contract, and we'll set up the loan per the contract, and then we'll get you out some disclosures. That way you see all the costs and everything right up front. And then we immediately, what we might find out when your home inspection is, if you're doing a home inspection, which again is separate from the appraisal. But then we will get the appraisal going, title work going. We have to make sure that the title is in good shape. You don't want some massive tax lien that the seller doesn't know about that is going to prevent the sale, right? So we get a title report, making sure you have clean title right off the bat. So all these things, there's just a ton of stuff that gets ordered, all these verifications, employment.
Stuff from the IRS, employment, from your bank, boundaries. I mean, there's just lots of stuff that goes into it.
Lots of stuff. So you get all those, and we compile that in a file. And once we get enough, then you turn it into underwriting. And that underwriter, so you want that underwriter to see that file. Gosh, best case, you really want them to see it as early as possible, so they can catch any major, things that may cause a problem for the loan approval. Because that underwriter, is the one who has the power of the pen.
Yep.
They either decline or approve. So you want to get this in as quickly as possible, so the underwriter can kind of start weighing in on this loan.
Yep. Yeah, that's a great move to make.
Yeah.
And usually what happens is the underwriter will go through the file and will say, yep, this looks good, this looks good. Oh, I have questions about this, I have questions about this. As soon as all my questions are answered with documentation, then I'll issue a final approval. And that's when we have final approval, that's when we're super excited.
Yeah, everyone's super excited.
Yep, so everything's in, all the appraisal, you might have a correction, from the appraisal or something like that. So underwriters look for all those things. And once you get that final approval, we get what's called the
Clear to close.
and we just cheer and jump up and down. Clear to close is our favorite term in this industry.
Mm-hmm.
Clear to close. And we get to make that phone call to you. We say you are clear to close. That means everything's good to go, and we just got to get documents to title and wrap this bad boy up for you.
Yeah, yeah, and one kind of interesting thing to know when you have that settlement deadline that we talked about earlier. So that's that signing deadline where you sign on the home. That's what we're talking about. We get the documents to title, you sign on the property, give the money for how much you need to bring in, and then usually it can happen that same day. Often happens that same day, but sometimes it's the day after, and there's no really set time on this. But then it records into your name, and then you become a homeowner.
Yeah, and so
I'm
when the
excited.
money from the bank or from us, our company, hits the title company, you've brought your down payment in, and they've dispersed it out to the sellers, the title company will go and record at the county that you are the official homeowner of the house, and at that point, man, you've got the keys to move in based on your contract.
Generally speaking, yeah.
Generally speaking. So sometimes you get contractual things with sellers where like they might want to wait a couple of days after funding or whatever, but your agent will help you with that.
Yep.
But the point is when that recording hits, it's your property.
That's it.
So
It's an exciting day.
and yep, then we're even cheering even more, and we're super grateful because you don't ever ask us to help you move in. Okay, now we get to talk about the fun part. Well, the last part was actually really fun.
Yeah.
But let's go. We're going to dive into a few details here for you on how to get approved for a mortgage or pre-approved and all that kind of stuff. And there's three main parts to the approval. That's credit, your income with your debts and employment, and your down payment. So if you have those three things in line, then generally speaking, you have a really good shot at getting approved. So
And as sort of a little mini disclaimer, there are so many variables here
yes.
that it's going to be impossible to cover them in this small class.
Yes,
So
yeah.
we'll try to cover the real basics, but you'll need to be pre-approved.
So
Let's just say it that way.
Yes. So your scenario, that's a great point because your scenario is going to be different than anybody else's on
Right.
the planet.
Right.
And so you
Like
might
a snowflake.
Yeah. So
Never.
you might have issues that nobody else or somebody else doesn't have or whatever. So again, the plug to get pre-approved early, and we can help you with all of this stuff. That's one thing. Eric is super experienced again at putting the right puzzle pieces together and getting the very best loan for you. Is different than I think any other mortgage guy in the state, to be honest with you. So, okay, so let's hit it. So getting pre-approved. We kind of already talked about this. Just a quick definition of getting pre-approved.
It's really just that, making sure that you don't have anything foreseeable that's going to prevent you from getting a home loan. If you don't need a loan, you don't need to be pre-approved. You got the cash.
Yeah.
But if you need a loan, there are certain rules to getting a loan that really all types of loan programs have. And they're all very similar. There's some unique things about each loan, but most loans have very similar criteria. So
Yeah,
that's what it is.
And they deal with credit, income,
Right.
down payment typically.
Right.
Yeah. Okay, so when we talk to first-time home buyers, a lot of times they will say, "Well, hey, I don't know where to go. I'm just going to walk into a bank. I walk into my bank and ask them about getting a loan." And so the question that often comes to us is, what's the difference between a bank or a broker or a mortgage bank, or what are you guys, blah, 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 blah. So let me just give you a quick definition. So our company, Leader One, we are by definition a mortgage bank,
Right.
but we don't do anything but residential mortgages. So we won't do car loans, take deposits, lines of credit, anything like that, personal lines of credit. We don't do any of that. Everything we're geared for and set up for is purely to get you a mortgage. So everybody along the way, along the staffing and the positions and all that stuff, are all designed in the mortgage arena. In my opinion, and I'm sure your opinion too, that is the very, very best setup.
Yeah.
So because that's what we think about all day long. We're not
Right.
going to go off and, okay, well now I think I can get your credit card here, and hey, maybe let's talk about a car loan, and and can we pull your deposits in? We don't do any of that stuff. And so it's a real advantage to come to a team like ours, because we don't have any of the other distractions, both on a structural level or a personal level. And we have access to all of the great mortgage banks, or many of the great mortgage banks, enough to we can provide you with the right type of mortgage and get you the right type of options. So application, you deal with this all the time. The application, what do they need to do to start a loan?
Yeah.
Yeah.
On application, we'll be real quick on this. All we do is we'll send you a link. If you're not comfortable on the internet, it's okay. We can do it by phone. But most people are getting that way. So we'll just send you a link. You apply online. It's easy.
Yeah,
It's
we'll
really
show
easy.
you a slick way to do it too.
Oh yeah.
Yeah.
Yeah, so it's really easy, and then we'll call you and follow up and kind of go through your application with you and make sure all the important pieces are in there, and then that's the very first step. And you're authorizing us with that application to pull your credit. So we'll look at your credit right off the bat and advise you in that way. That's the application.
Yeah,
Not much to it, really.
Yeah, so you do the application, and then Eric and the team will screen it, pull the credit, and then they're going to create a needs list for you based on what you've said. So that needs list often includes bank statements, pay stubs, W-2s, tax returns, those general types of things.
Yeah. It's most of the time 2 of everything.
Yeah.
2 tax returns, 2 pay stubs, 2
And
W-2s.
yeah, and then once we have those hard numbers, we can pencil out the numbers for you and crunch them and say, okay, you've got this much for down payment, or your credit score looks like this. You might want to consider this type of loan, or this type of loan based on what your credit is, and then we'll give you all the options.
Yeah, and sometimes people are concerned about, okay, my bank statement does not show, or my pay stub doesn't show what I'm going to be making because I'm getting a raise next week or next month, or I'm, my dad's gifting me money, or something like that. So it's okay if it's not perfect. We can chat and we can kind of supplement as we go along. The pre-approval is about looking at that and then also discussing what's going to be changing in the near future. So it's okay if not everything's perfect with the documentation. We can
Again, another plug for getting started early.
Right.
And in the pre-approval process, we sometimes people will feel like they have to be shy about certain things, like they want to hide, I don't know if my credit score is very good. It doesn't help you to hide information. It only helps you to be in full disclosure.
Absolutely.
The more you can tell us, the better off we'll be.
Or they want to pretend that the money is theirs, that they're getting from a gift or from a...
Yes.
It's better for us to know where everything's coming so we can advise you how to document it.
Yep, because documentation, that's a great point. Documentation is the name of the game. You have to document everything.
Right.
And so we have to help you understand, hey, if your money's coming from a parent, that's totally fine in a lot of cases, but you have to document it correctly.
Right.
So
Right on.
Okay, so credit. Man, we get asked credit questions all the time. So credit scores. What are good scores? What's considered a good score?
So every loan program has a different score criteria. We could go into some programs now or not, but basically, to have perfect credit, you're probably looking at a score upwards of 760 and above would probably be considered perfect credit for most programs. Anything between 620 and 760, and that's a big range. But 620 and 760 is sort of the credit score that you need to get a home loan. Wouldn't you say that?
Yeah.
There are some loan programs that will go below 620,
right?
Even down to 580, and there's even some that go down to much lower, 500 even.
Yeah.
They're a little more difficult to get. Obviously, less lenders will do them. But I would say the kind of the sweet spot would be between 620 and 800, or anything above 760.
And as your credit score drops, obviously, your loan might get more and more expensive. It kind of depends on the loan program.
It's true.
But that's something to be aware of as that credit score goes down. Now, that doesn't mean that you're out of hope if you have, say, a 640 score, or 620, or even 600. It just means that we have to try and make it up somewhere else.
Right, and less programs are available.
Right, yep. So your credit score is super important. Oh, and to go with that, by the way, there are 3 bureaus, and we will take mortgage loans. We'll look at the middle of the 3 scores.
Right.
Yeah. So we get asked that question all the time.
Not the average.
Yep. Not the average. Middle of the 3.
Middle of the 3 scores.
So if you have thin or bad credit, what about that?
Thin credit is considered credit where you only have like maybe 1 or 2 credit trade lines, they call them, on your credit report. So and they may not even be for as much as 12 months. You may have just got a credit card 6 months ago, and that's your only credit.
Yeah.
And that's thin credit. The crazy thing about that is you can still oftentimes pull a credit score. Let's say you have a bank card, and you've had it for 6 months. You may still show a 700 credit score with that. We've seen it many times. But that is thin credit, and certain loan programs require you to have a little bit more credit than that. Others don't. Generally speaking, conventional loan, you can have thin credit and still do a conventional loan. So, and FHA, there's ways to get a loan with FHA, and that's another loan program. But there's ways to get a loan with thin credit. So thin credit's not a deal killer. Having very few credit lines is not a deal killer.
Right.
I don't know if that's what you want to
That's great. Again, I know we're going to keep saying this a million times. Another plug for starting early.
Yeah.
Because it just gives you time. I mean, if you need more time to build some credit, then it gives you time to do it. Or if you need to fix your credit, pay off some collections if you've got collections, for example, or pay down some credit cards if that's hurting your score. Your options for bad credit, we're going to take a look at your credit report and go through it with you. And oftentimes on the report itself, we'll get an analysis that says, hey, if you do these things, then your score can rise. So,
sorry, go ahead. I was going to say one quick tip on that.
Yeah.
And this was just a quick tip. That actually, what Darren just talked about there, about having maybe a high balance on a credit card. Let's say you only have one credit card. It has a $1,000 limit, and you owe $999 on that. That can actually affect your credit in a really big way. It can take that score down. And by just chunking that credit card down, to 30% or whatever, sometimes even to 0, don't close it out, but by paying that down, your credit score can come up. And we're talking big numbers. I mean, it can be 50 points. I've seen it.
Yeah.
Seen it. So that's a quick tip.
Yeah. So the cool thing is the report itself will give us advice.
Right.
And then we can, we can help you with that.
Yeah.
So once we pull your credit for the pre-approval, it's good for about
120 days.
120 days,
Yeah.
so we can go off of that report. We generally do what they call a credit refresh. So you always want to be doing things to increase your credit score or at least sustain it.
Yeah.
So big question that always comes up: will pulling credit hurt my score?
Yeah, I hear that from everybody. It's funny. People are much more worried about that than they are about. A lot of people are more worried about that than they are about having a collection on there.
Yeah.
It's really funny. It's really one of the lighter things. If you're careful and you're not going to every shop and having them pull your credit, 30 days a month or something, you're going to be fine. Just when you need it, it could affect your score. Yes, it can affect your score, but it's a really small. From what we have seen in the past, pulling your credit 1 or 2 times in the month, it's nominal.
Yeah, and where that comes from is, sometimes, if you go to a job fair or some kind of fair. I remember back in my college days, there was all these booths from like American Express and Discover, and they all wanted me to sign up for a credit card. And so you just go around and you'd fill out your application. Oh yeah, sure, I want a credit card. I'm an adult now, or whatever. That's what I thought back in the day. I'm an adult. I guess I get a credit card. So you fill out 5 applications, and guess what? They're all going to pull your credit.
Right.
And all of a sudden, the credit bureaus are, the sirens are going off. Oh, this guy needs some cash fast because he's applying for everything, and so that probably wasn't very good for my
so
score.
they think you're a credit risk.
Yeah.
At that point.
So that's really where it comes from. But on the mortgage side, you can have it pulled, a few times. It's really not going to do much.
Right.
Yeah. Okay. On to employment and income, and we've already kind of alluded to some of this, but let's just take a couple minutes and hit some of these salient points.
Yeah. So we've hit a little bit, just to kind of go back to what we were saying before about debt to income ratio. So the underwriters take what's called qualified income, and then they compare that with your monthly debts, including the new house payment. And the new house payment includes principal and interest, if you have some property taxes, homeowners insurance like fire insurance, and if you have mortgage insurance, that's in there too. And maybe if you're buying a condo or a townhome or something like that with an HOA, that's included. So there's a lot of things they look at for your monthly payment that gets included in your debt ratio. But what they look at, they look at your income and they want to make sure that they can use qualified income. Qualified income means that they are looking at the history of your jobs, your job. I mean, you don't have to. They look a lot at your last 2 years of your job history, and then they try to get a feel for what your income is, and then they compare that with your debts. And usually, for most loans, like we said, they want to see that you're at or below about 50%, and they look at your gross income. So before taxes are taken out. So they want and that gets more refined than that, and we can kind of go into that, and you'll go into that.
So let's say you make a salary. In fact, well, I don't even need my calculator. I was going to pull the calculator out for that, but let's say you have a gross salary of $4,000 a month. That's gross. So you would take half of that, which is $2,000,
right?
And your house payment, all your debt payments, student loans, credit cards,
car
payments,
yep.
All of that needs to fit inside of that $2,000. Now,
exactly.
Some loan programs are less. Some are 45%.
Right.
And sometimes you can go a little bit higher depending on the program, up to maybe 55.
Yeah.
In that range.
Yeah.
But so 50 is a pretty good place, to at least start your numbers. 45 is the most conservative.
Yeah, probably 45 would be if you're
safest.
Yeah, would be the safest.
So So take your gross monthly income, take 45% of that house payment with everything that Eric mentioned, plus all the other debts have to fit in that. Now you don't have to worry about other housing expenses, typically like cell payments or cell phone payments or health,
car insurance.
Yeah, car and health insurance bills, that kind of thing. It's just debts, purely debts.
Right, and so the only time it gets I shouldn't say the only time. It's often tricky, which is why you need someone who has experience, to do this. But it's not everyone's a salary borrower. Okay, so if you have fluctuating income, sometimes they have to average your income. If you're self-employed and you own your own business, they're going to look at your tax returns, and then they're gonna average that income most of the time. Not always, but most of the time they'll average over the last couple of years. So getting to that qualified income, which is the income that the underwriter can say, yep, she's stamping it, she's saying I can count that income as qualified income to pay back this loan. That's what we as loan officers do. We try to make sure that we understand what your qualified income, so you can have a real debt ratio.
Yeah, I think that's perfect, because if you're hourly, full time, and salaried, then it's a little bit easier. I mean, it's a little more straightforward. But where we come in to really, really help is when you're self-employed or commissioned or bonus, part-time, anything that is variable. There's certain ways to calculate it to get it accurate. So, another question we get all the time is, how long do you have to be on a job? Everybody says, I got to be on the job for 2 years.
Yeah. So they will look at the last 2 years of your history, but for example, the salary or the hourly, you may only need to be on the job for a day. I mean, the program, it depends on the program, but it's often a lot quicker than people think with a salary or hourly job. A lot of times they want to see a pay stub or two on your new job. But where you need a longer term on your current job is usually when you're self-employed, when you're an owner of a business or something like that.
Yeah, and especially where this applies is if you've been in college and now you're just graduating, you haven't had a job because you've been in college full time, but you're getting a job that's in your field where you studied, then oftentimes they'll count the college as your job history.
They sure will.
So you didn't have income there, but it's that trajectory that you're on.
Right.
So if you've been completely unemployed for a couple of years and now you're starting a job, you might need to be on the job a little longer than a day. But
6 months or a year or something.
But you can, as long as you're working up, you don't have to be on a specific job for 2 years.
Right.
So
that's a common misconception.
Yep.
Yeah.
All right, we've hit credit and we've hit income and job history, that kind of thing. Let's talk real quick about down payment. This is a hot topic.
Yeah. Should we kind of get into a couple of the programs?
Yeah.
What they require?
Yeah, we could do that. We'll talk about programs here in a sec, but I mean, it all works together. So.
Yeah, so basically, there are some zero down payment options out there. And two of the most popular ones, I would say, in this area anyway, are a VA loan, and USDA. VA is for veterans,
Military
It's
veterans.
military and National Guard, and you know you have to meet that, and there's we'll get into the programs later, but basically if you qualify for a VA loan, it can be as low as, and often is, as low as a 0 down payment.
Yep.
Meaning, remember how we talked about the closing costs and the down payment, the principal down payment. There's still closing costs on a VA loan, but that down payment portion, that 5%, 10%, that portion, the VA will allow the veteran to buy a home with no money down payment. So
But
it's
if you're
a great loan.
not in the military or not a military veteran, you're out.
Yeah, so that's VA. Then you have a USDA, which also allows a 0 down payment. And it's a terrific loan. But again, no down payment. There are some closing costs on that, but there's no down payment. Those are probably the two that we see the most.
Yeah.
No down payment loans.
Most popular.
Most popular.
Because they're very, relatively inexpensive for 0 down.
Yes.
Yeah.
Yeah, good loans. And then there are low down payment loans, such as FHA. FHA is really common, and a lot of people do FHA. It is a really good loan. It's a government-insured loan, and its standard down payment is 3.5%. So you buy the $200,000 home, your down payment is $7,000.
I just did the
Did I do
math in
that?
my head, and I think that's right.
That's right. And then also there's to kind of compete with FHA, you have a conventional 3% down loan. They differ. There's some pros and cons to both of those, but conventional has a 3% down loan. It's a little less common. Probably, I would say the most common that I see conventional loan is somewhere between the 5 to 20% down range. So again, the $200,000 loan, you're looking at $10,000 all the way up to $40,000
Yeah.
for a down payment.
So if you're a first-time home buyer and you want a target to shoot for, if you can get 3.5%,
Right.
then that covers at least 2 programs outside of VA and USDA.
Good. Yeah, it's a really good point.
Yeah. So if you came to us and said, "Hey, I've got 3.5% saved up, or I've got a source that I can get 3.5% from," okay, then we can. You start having options open up, and the more down payment you have, the more options you have.
Yeah, and that's a good point. You said if you have it or you can get it.
Yeah.
So sources do matter. They source. All underwriters source where your money's coming from. So you want to, if you're getting the money from a gift, that has to be a family member. So you can get a gift from a family member, like your dad or your brother or whatever, cousin. All of those count.
Although we found that most brothers just won't give money.
That's true. It kind of is always the dad and mom.
Yeah.
So, so that's a good place to get it.
That's a joke.
But somewhat true. But also, some people will sell things. Like I've seen people sell cars to get their down payment, computers. So selling, you can actually get a loan on an asset to get your down payment.
Yeah, I had a client one time, a long time ago, but she had a car that she owned free and clear. And
perfect.
She got a really low rate on a car loan, so she just pulled she only needed $5,000 or something.
Perfect.
And she pulled it out, and it worked great.
401k.
Yep.
401k is another one. Yeah, because that's a secure. So a lot of people will pull the money out of the 401k. Those are the most common, I would say.
Yeah.
Yeah. So there's a lot of sources. So get creative. If you don't have one, because if you get that 3 to 3.5% down, you just start getting into better mortgage loans. A mortgage is another word for a home loan. I don't know if we've said that yet. But it's better. Your financing's better.
You just have more options.
Yeah, your options go way up.
Yeah, and we found that typically speaking, not in every case, but the less you put down, the more risk it is to the lender.
Yeah.
And so the expensive or the tighter the loan can get on you. Not always, but you just open up more options.
Gives you a little cushion too. Let's say you have to sell the home sooner than you thought. Let's say a couple of years down the road you have to sell the home. Maybe you're moving to Alaska or something, and you just don't want to keep it. If you have put a little money down, there's a little bit of a buffer where you may not have to bring in as much money when you sell. So it gives, price fluctuation or whatever. It just gives you a little bit of a buffer there.
Yep.
So
and again, another reason to get started
early.
Yep, exactly right. Okay, so lots of loan programs. How do you sort them out? We've kind of talked about different programs and that kind of thing. So really quick, what's right for somebody? How do they know they're getting the right program for them?
Get pre-qualified by a really smart loan officer.
Yeah.
Number one. And but really there's a lot of truth to that, because there's a lot of programs out there, and sometimes some people are wanting to funnel you into their favorite program.
Yeah.
But what you want a full service lender who does all the different kinds of loans, so they can sort of look at all the variables and put you or give you the options where it'll save you the most money.
Yeah.
So I would say the most common are conventional loans, FHA loans, and the reason why those are the most common is because they allow for a fairly low down payment, but they also have some like FHA, for example. FHA allows for some bruised credit.
Mm-hmm.
If you've had some credit problems in the past, and even a little in the recent, you can look at FHA and FHA. So an example, just a quick example. FHA, if you had a Chapter 7 bankruptcy even as early as 2 years ago that discharged, slightly more than 2 years ago, FHA will look at you. And obviously you have to still get qualified, but they will look at you. Whereas some other loans, like a conventional loan, in this case, a conventional loan wants a little more time. They want more like 4 years. But that's just an example of why FHA might be the right program for someone.
Yeah, depending on your background, for sure.
Yeah.
I will say this, and I know Eric feels 100% about this, or agrees 100%, and that is, there's nothing that's more exciting, really, than when that borrower goes to the closing table and we've worked out the coolest loan program for them. Oftentimes one they had no idea,
Yeah.
and they're going in, they found this awesome house because they've had a great experience with a realtor, and the finance package is just perfect, and we put things together for them, that they didn't know they could do. And
So true.
and it is really, really gratifying. So bring what you've got to the table, and let's put the different pieces in place. And gosh, I remember sitting one time actually with a guy who's actually now a really great friend of mine. I went down to his office and we sat there, strategized for 2 hours. And when we came away, we had a totally different roadmap than what he had in mind. It put him in a way better spot, and it was, to this day, I look back on that with really great memories.
That's awesome.
yeah.
That's true.
Yeah, it really helped him.
We love to see that. We especially love to see it when they didn't think they could do it in the first place.
Yeah, yep. So what's right for you? Just bring it to the table and we'll get it figured out. Mortgage insurance. People ask about mortgage insurance. Just give us a quick definition and we'll...
Yeah, mortgage insurance is not, this is my opinion, of course, but I don't think it's something to be scared of. Mortgage insurance, you'll hear of mortgage insurance a lot as a first-time home buyer. If you don't have 20% down payment and pretty darn good credit, you're probably going to be looking at mortgage insurance. FHA has it, USDA has it, and conventional loans have it. So what mortgage insurance is, it insures the lender in case you don't make your payments. That's really what it is. It covers the lender against their losses a little bit. And so when you get mortgage insurance, most of the time, and it depends on the program again, but most of the time it's there for a period of time. And you kind of make it with your monthly payment. You'll make a mortgage insurance payment with your monthly payment.
Yeah, so it's a little fee,
Yeah.
monthly fee that gets added to your monthly payment for allowing you to not have 20% down.
Right on.
Yep.
You said it much more succinctly there. Sorry.
I was really bored. So there's options for mortgage insurance, and again, we can look at that. But just be
Yeah.
aware, if you don't have 20% down, then it's something you've got to deal with,
Yeah.
one way or the other.
And I've heard people say, mortgage insurance, and you'll hear this, mortgage insurance is a ripoff and banks shouldn't be charging it. But what it really is, it allows the banks, it makes it possible for the banks to do a loan without requiring 20% down payment.
Yeah.
So it's actually a good thing.
Yeah, and there's different ways to get it covered.
Yeah.
Different ways to get
Absolutely.
it covered. Yeah. Okay, so really quick, closing costs. So closing costs are the fees that it takes to get your finance package in place. And there's typically two sets, what we call hard costs and then prepaids. Hard costs are money that's out the door, like appraisal fees, fees to the lender, title fees that are just gone to get that, to pay for services to get your financing. And then you also have another set, which is a little bit smaller. It's we call them prepaids because you're prepaying some taxes and insurance and some interest at the time of close. So you bundle those all together, and on average, you want to plan on about 2%,
Yeah.
maybe 2.25% of the loan amount to
For all of
close.
that,
Yeah,
yeah.
so your down payment plus a little bit more.
Yeah.
Now the cool thing is, so that's a cash to close thing. The cool thing is we brought this up before. The sellers can actually cover those. So your realtor can write it up. So if you have, say, $5,000 total in closing costs, they can write it up, and if the seller agrees, the seller will actually give you a $5,000 credit at close.
Right.
Yeah, so there's ways to do, or you can get credits from lenders if you do structure your loan the right way too.
Right.
So but closing costs are a cash to close issue, and we want to get that addressed up front.
Right. Right.
Yeah. All right, so where to start? We've gone through a whole bunch of stuff tonight, and we want to just put together a quick roadmap for you, or at least help you so you can formulate your own roadmap, and so you can know, hey, where am I going to go? All right, so the very first thing that we like to have you do is we like to have you put together what we call a priority plan. And the priority plan is come up with things that are important to you and anybody else that'll be living in this house.
Yeah.
So, and it doesn't necessarily have to be financial. It could be anything like, hey, you know what? I've got a huge dog and I need a big yard. So that's a priority. Or I want to move as far away from the in-laws as possible. That's also a priority.
We just assume that.
Yeah, yeah, that could be a huge priority. Okay, so come up with your priorities.
And this does not have to take long or be difficult.
No,
It's just,
no.
what do you want?
Yeah, what do you want? And then rank your priorities. So, is being away from the in-laws the most important thing, then your monthly payment, then, you got to work out that. So come up with your priority plan. That will really help you get going. And then examine your current situation. So if you want to, move, down into, the boonies of Utah somewhere to get away from the in-laws, again, if that's your priority, then, is your employment going to be able to handle that? Can you find a house there? That kind of thing. So examine your current situation. And then once you got that put together, it's time to assemble the team.
Yeah.
And what I mean by that is
Call us.
give us a call.
Yeah.
Give us a call. And then we will help you get in touch with the right people. If you already know a real estate agent that you want to work with, great. If you need referrals on that, man, we can totally help you out with that too. So you want to get the right people in place, and is it ever too early?
No.
No, never too early.
Yeah.
So,
We've worked with people for years before.
Yeah.
So it's
yeah. And it's never wasting our time. So come in and get pre-approved. We can do it over the phone. Actually, we're going to show you a really cool way to get pre-approved. That will be our parting offer for tonight. Did your phone just go off? So Eric's super busy, of course. He won't take this call because it's his wife, but he'll take your call if you call him. So
right.
speaking of a
That really
priority,
was my wife.
speaking of a priority plan.
I'll call her right back. Don't worry.
Yep. So we want to get you pre-approved and get you some referrals out to people that can help you out, walk you through all the steps, and get started. So here's our offer for tonight. We're actually pretty excited about this. We've made it really, really easy to go through that pre-approval process. So a couple ways you can do it. You can give us a call at our office, 801-810-5341, or you can text that number too. That's fine. You'll get in touch with Eric, and Eric will help go through the process. But if you don't want to talk to us, which, man, we completely understand, my gosh, then we have got a really cool tool, which the link will be provided. But let me just give you a quick what it looks like. It's a step-by-step questionnaire that you can do on your phone. You can do on your iPad. You can do it whenever, whatever you want to do. Okay, so it's going to just walk you through. Hey, what do you want to do? Do you want to buy a house? Do you want to refinance? How much are you looking for? It'll help you with the priorities, and then that information will come to Eric. He'll be able to screen it and then to start working out the numbers with you.
Right on.
Yeah. So that it's not an application. It's just a link. Again, the link will be provided. Just
But it does give us authorization to pull credit.
It does give us
So be ready for us to pull credit. At that
Yeah.
point.
Now, if you don't want us to pull credit, then just call us or
Yeah.
shoot us a quick email or text or whatever.
Yeah.
Hey, I did an application. Don't pull my credit yet.
Yeah.
And that's totally fine too. So, but that's our offer. It's totally free. We'll pre-approve you for free. We won't charge you for credit reports. A lot of places will charge you for that. We won't charge you for time. We just want to help out as many first-time home buyers in Utah as we can. So let's get that pre-approval process going as soon as possible. Again, I don't care, and Eric doesn't care if you're looking at 6 months from now or a year from now. Let's get it rolling.
Right on.
It'll just help you out a ton. So if you have any questions, you can, again, call us or text us, but we'll have, here on the class, you'll be able to submit questions through the webinar interface. So send us those questions. We would love to work with you. We've been helping first-time homebuyers in Utah for,
Long time.
yeah,
20 years almost.
Some of you probably were in diapers, actually, when we were helping the first one. So
Hard to believe.
Oh, I hate to think about it like that, but sad but true.
Yes.
But no,
It's true.
this is our passion. We love helping you guys out, and we hope this has been really, really useful. If there's anything you've missed or we've missed, or you want some more details, just get in touch with us. Anything else, Eric?
No, shoot us your specific questions. We'll answer them.
Okay. All right. Well, we will talk to you soon. If you know of anybody that this could help, or if this information could help, then please forward and share it with them. That's
Right on.
That's the neighborly thing to do.
Yes.
So,
We all like being good neighbors.
okay. Thanks so much.
See ya.
Talk soon.